Okay, this next little piece of business is pretty important. This is where we really get into the nuts and bolts about what accounting really is and how we capture those transactions and some of those kind of things. Everything starts in accounting with this thing we call the fundamental accounting equation. A equals L plus OE, right? Simple little equation, and let's talk about what it represents. A, we know, stands for assets, right? L for liabilities, and OE for owner's equity, right? So that's what the words stand for. What that really means is assets. What are those? Those are things that we own, right? So like if I have cash in my pocket, that's an asset to me. If I have supplies in my closet, or I have a vehicle or land or a building or any of those kind of things, those are all what? Things that I own. Those are assets to me, right? Liabilities, we're probably more comfortable with that than we really want to be, right? We know that that's things that we owe to somebody else. When we owe something to somebody else, that's a liability. Owner's equity we can think of in a couple of ways. Net worth is one way people describe it, or residual value, right? That's another term that we could use. If you think about it, if you took everything you owned and you sold it, and you paid everything you owed, what would you have left? You probably understand more about this than you really think, right? If you put this in context, if we have a house, and this house is worth $200,000, right? We bought this house and it's worth $200,000. If we owe $125,000 on it, right? If we owe $125,000 on it, that means that our equity or our residual value in that thing is $75,000, because $200,000 equals $125 plus $75,000. That's really all it means in a business context. Same deal, right? Same thing. So everything starts with this assets and liabilities and owner's equity. So that is an important part of the deal. Now we know that that we have to take it to the next step. If this is our business, right? We have our assets and our liabilities and our equity. We want to know how this changes, right? Because this is really the owner's investment in the business. So let's think about this a little bit. Let's forget about this now. Okay, those are gone. Say that the owner takes money out of his own pocket, right? And he invests it in the business. Remember the business entity concept that we said, the owner is different from the business. So from the business perspective, what happens? Now the business has more cash, right? More assets. So assets go up, and we know what happens to the equity. Equity goes up, right? Because why? This person made an investment in the business, right? They made an investment in the business. Okay. Next thing that happens, we're in a lawn mowing business, right? We go and mow somebody's lawn and they pay us cash, right? That's a good thing. That means that we're doing what we're supposed to be doing, right? What happens to the equation when we do that? Well, we know I get paid cash, right? So money comes to me. Why did I get that money? Because I earned it, right? I was out doing whatever it is that I do to earn money. We call that revenue, right? That's the revenue side of things. Now, that doesn't come free, right? Because I have to pay things. I have to pay my electricity bill, right? So I pay my electricity bill. What happens to my assets? Well, my assets do what? They go down. And what is that electricity to me? That is an expense, right? So what happens to the value of my business when I pay expenses? Down it goes, right? Now, other thing that can happen is the owner puts money in the business when he starts it, but he would like at some point to be able to take some money back out of that business, right? So if he's taking money out of the business, what happens? Assets go down and the value of the business goes down. We call that, by the way, withdrawals, right? Withdrawals. So what we can take away so far, we have our equation, assets equal liabilities plus owner's equity, and we know that the value of my business is affected by what? 4 things, right? 4 things that affect owner's equity, right? Revenue, expenses, investment, and withdrawals. It's also important to notice, too, right? We know those 4 things affect the value of my business, and this is going to be important later on. If I take those 2 and I wash them together, revenue minus expenses, I get profit or net income, right? So those are the 4 things that affect the value of my business. Revenue and expenses, when we wash them together, revenue minus expenses, we get profit or we get net income, right? So that is the fundamental accounting equation and the 4 things that affect owner's equity. What we're going to do in the next video is we're going to take and put this into action a little bit. We're going to look at how we actually record transactions using this framework. So there we go.